Hey everybody, welcome into Mining Stock Daily. This is this week's long form episode. I'm Trevor Hall, your host. I'm trying to get back into a regular schedule here on the podcast after last week being on vacation. And I think we did a pretty good job of it this week. What a week to be back, because there was so much going on in markets, not just precious metals and all the junior exploration news. We're starting to see a lot of results come in. We did a number of corporate updates this week. You can go back to Mining Stock Daily and pick up on any of those conversations we had from people out in the bush doing some really good work, including Snowline Gold, I might add. We got a follow up with Scott Bird also. Do go back and listen to some of those corporate updates. In this week's long form, we welcome back Jesse Felder of the Felder Report. Listen, there's a lot of things to talk about. There was no stone left unturned in this conversation. We talked the bullish bearish case in bonds, long end, short end. We talked a lot about precious metals, and also obviously the CPI inflation print and the market reaction to that. So there's a lot to go on. If you're an investor participating in these markets, head on swivel. There's a lot to be watching. Special thank you to Western Copper and Gold, Fireweed Metals, and Arizona Sonoran Copper for their continued support of the podcast. If you wouldn't mind, hit that like, subscribe, share, all those things on both the YouTube channel and on the podcast. Very much appreciate sharing all of our stuff. We're looking forward to having an excellent fall. Going to be real busy. All right, let's jump into my conversation with Jesse. Have a great weekend, everybody. Be well. Hey everybody, welcome back into Mining Stock Daily in this week's long-form discussion. In just a really newsworthy week all around. Market volatility, questions on bullish or bearish cases with the bond market. Well, obviously we had CPI that came in basically as expected, except core popped up just a little bit. And there was volatility as we are recording this Thursday late morning here, my time, after the CPI print. So happy to welcome in Jesse Felder of the Felder Report, where we are going to talk everything, all the things, Jesse. Oh my gosh, what a week.
Tons to talk about. So
yeah. Oh yeah. If only there was just a bullet point list of things that we could talk about. Listen, okay. So CPI came in basically as expected, 3.2%. Just remind everybody, that is coming down from that high of 9.1%. That core rate, however, that's a key metric for the Fed, did rise 0.2%. Obviously, core inflation, that excludes food and energy, Jesse. You know, let's just use this as kind of the gates of the conversation for the next few minutes here. What are you seeing from inflation, the CPI print, and what do you make of it this month?
well, there's so many moving parts. It's really difficult to parse, and everybody has their favorite measure of core inflation and super core and core excluding, whatever. But I think it's been pretty clear, that when you look at the base effects, the year over year stuff, like you talked about a year ago, we were at 9%. And so the year over year comparisons were always going to be difficult. Research Affiliates has done a really good job writing about this over the last 6 months plus, suggesting that, of course, we're going to see disinflation through the first half of the year, just because of the base effects, just because the year-over-year comparisons get so difficult. It's really hard to have another 9% on top of 9% a year ago. So we've seen this disinflation a lot because of just the trend in inflation last year, which you had accelerating inflation into mid-year and then, decelerating inflation in the second half. What that means is starting, with this month, which is why we saw, things, the year-over-year comparisons start to tick up again, is the comparisons start to get a lot easier. And I think that's, I think it's B of A has put out a piece showing that if the month-over-month numbers just stay at like 0.2, we're going to see inflation rise headline from 3, back to 4% through the end of the year. That's just if the month-over-month numbers just kind of stay at this relatively low level. Now, there's reasons to believe that they might not stay that low, right? We've seen oil prices pick up again. We've seen gasoline prices, start to take off, natural gas. A lot of these things, have suggested that, the disinflationary trend that we've seen is potentially reversing. And even the Wall Street Journal pointed out today that the way CPI works is they take the average gas price during the month. And so, the uh, rise in gas prices that we saw last month was not reflected in last month's CPI. This month is going to be a different story. And so, one of the people I rely on for kind of parsing the CPI data is a guy named Michael Ashton. Calls himself the inflation guy, but he's the most I guess knowledgeable inflation watcher that I pay attention to, and he suggests that August looks like we're going to see a return to kind of rising
Hmm.
inflation numbers again. And I think that's, if markets are forward looking, they have to start looking at these base effects, and the year-over-year numbers are going to start to look bad for the Fed. At the same time, the month-over-month numbers could start to look bad also because of rising, gas and oil prices. So I think we're probably at a turning point here. The easy part of the disinflation is over, and so markets are now going to have to reconcile with the fact that disinflation is probably not going to continue. So that means the Fed has to at least remain tight, if not
Right.
continue tightening. And that's, I think, something that, like I said, the markets are going to have to wrestle with from this point going forward.
One of the questions I asked you, and I know this is kind of a hyperbole type of question, but I wrote down, is it mission accomplished for the Federal Reserve here? I don't necessarily believe it, but listen, I will give a little bit of credit that they have brought down inflation, those, from 9% down to almost 3% here. But we're at a pivotal point here in a conjuncture, because listen, I'm with you. That oil move that we've seen the last couple of weeks are not built in to this recent CPI print. You mentioned natural gas, and I'm actually looking at some of the food costs as well. Grains have gone up. Wheat has been kind of a volatile market as well on the upside because of geopolitical reasons out of Ukraine and Russia. I mean, so there's a number of factors, and I'm with you. I think we potentially will see an uptick next month in CPI. I'm not quite sure what that looks like right now. I'll let you people smarter than me to kind of analyze that. But let's talk about, I mean, did the market, a lot of the equity bulls, get ahead of themselves thinking that that 2% inflation average was going to be met by the Fed and they would pause and maybe even cut rates? Did they get well over their skis here in the last couple of weeks?
Yeah, I love that you bring up mission accomplished, because I wrote about that a couple of weeks ago. Where I think yes, I think this is a mission accomplished moment from the standpoint of George W. Bush standing on the top of the aircraft carrier 3 months into the campaign in the Middle East, declaring mission. He didn't
Yeah.
technically use those words, but the banner "Mission Accomplished" was flying in the background,
I remember it
suggesting that
vividly. Yeah.
they
Yeah.
believed in the very early days of the campaign in the Middle East that the mission had been accomplished. Obviously, 2 decades later, the mission was still not accomplished, and I think that's probably the perfect metaphor for where we are in inflation. That we've had some good early success, and the Fed's shock and awe. I mean, the metaphor you can take and use forever, right? The Fed implemented shock and awe very much like we did in the Middle East with the onset of that military campaign, and it's resulted in what looks like a rapid disinflation. Now, I don't think we've seen that. A lot of that is not relative to monetary policy. Most of that is really just due to oil price coming down and these types of things, and normalizing of supply chains and whatnot. But I do think that the markets have priced in uh, mission accomplished, that the Fed has done enough to sustainably bring inflation down, and they're going to be able to start cutting rates without, causing a bigger inflation problem down the road. And I think that's problematic on a number of levels, right? Because if you buy the soft landing thesis, you believe that inflation has been brought back under control and we're not going to have a recession. And I think both sides of that are probably too optimistic. I think we're probably staring at a stagflationary environment over the next, couple of years, where we see real economic growth continue to decline, at the same time as inflation, settles in, at least settles in at a higher level, if it doesn't start to reaccelerate to the upside at some point over the next couple of years. So I think that mission accomplished metaphor is perfect, because what it signifies is an extreme amount of overconfidence relative to where we are in this process.
And it's interesting. I think, thinking back to American history, I mean, I remember George Bush standing on that aircraft carrier. I was in college at the time, and we were not prepared for the longevity of that war at that moment. We thought we believed him, and and I guess are we prepared as investors for this higher for longer type of interest rate environment? Are we prepared for, maybe since the Fed decided that they are not going to be calculating recession risks anymore, maybe we will be hitting a recession? I mean, how prepared are we economically for what could be a long drawn out battle here?
Well, it depends on what market we're talking about. I think the stock market is not prepared. Like I said, I think the stock market has priced in a soft landing. And that is that you don't get the earnings decline that we've seen does not grow into something more significant. And in fact, what markets have priced in is a dramatic rebound in earnings growth, starting this quarter and through the end of the year. So if we are actually not headed for a soft landing, and we are headed to recession, the earnings estimates for the next several quarters are going to have to be dramatically revised, to the downside. Stocks aren't prepared for that. On the inflation side, if inflation remains elevated, right, you're not going to, the valuations on those earnings are also very extreme, right? We're looking at PE ratios that are higher than anything over the past decade. And you could argue the past decade was elevated relative to long-term history. So, Apple's probably a really good example, trading 30 plus times earnings with negative revenue and earnings growth, right? That just makes no sense. I mean, that's an extreme, and they don't have any cash on the balance sheet to speak of any longer, right? It used to be that Apple was trading, 10 times earnings and had massive net cash on the balance sheet. It's the opposite situation today. So but that's representative of the broad market. Where should Apple trade? Probably under 20 times earnings, for where the trajectory of its earnings and revenue growth are, and where interest rates are, and these types of things. And so that's probably representative of the broader market. Now, so the valuations in the stock market have also embedded this idea that interest rates are going to come back down to very low levels, right? That's what's kind of justified the bullish case for high equity valuations over the past number of years, is that interest rates are so low. It justifies high multiples. So the only way you can justify those high multiples today is if interest rates come dramatically back down. But one market that I think is starting to price in the higher for longer, the problematic trend in debt and in inflation over the next several years, is the Treasury, the bond market.
Yeah.
Look at the 10-year Treasury, look at the 30-year Treasury yield, and these things are breaking out of a consolidation pattern over the past year. Rates could, at the long end of the yield curve, are already starting to head higher. So that's and that's what I think the equity market is starting to wrestle with. That if the bond market is starting to say inflation is not sustainably brought back down to 2, that mission accomplished is not going to materialize here. That the Fed still has work to do, inflation's still a problem, and the rapidly growing federal debt is still a problem. Then the equity market's going to say, okay, well, maybe we've been a little too optimistic. And so I think it depends on what markets you're talking about. Bond market seems like it's starting to kind of price in some of these other risks we're talking about.
You mentioned Apple's price to earnings ratio, almost reasonable compared to Nvidia's. Right now, it's over like 220.
Yeah.
I mean,
Yeah.
just crazy. And
Yeah,
their
well, I mean, and
financials come
40,
out in a
40
couple
times
weeks.
sales, right? I mean,
Yeah,
we famously, everybody
yeah,
should know by now. I mean, I think I've written it in blog posts, several times in the past 5 years or so. Scott McNealy's quote about Sun Microsystems, the stock he, founded and was CEO of in the peak of the dot-com mania. We wrote about how crazy investors were. Actually, it was an interview. He talked about how crazy investors were to pay 10 times sales for Sun Microsystems. And Sun Microsystems was building out the backbone of the internet. It was just, very
right.
much like NVIDIA building out the backbone of AI today. He thought investors were absolutely insane to pay 10 times sales. Investors today are paying 40 times NVIDIA sales. So
Right.
it's a very comparable situation, although it's more extreme today than it was back then.
You mentioned the bond market, and obviously that's been like a key focal point leading up to the CPI print the couple days beginning of this week. And I had a great conversation with Peter Bookvar. Love his work, and I'm going to ask you the same question I had for Peter, because I understand the bullish case for bonds right now, and I understand the bearish case for bonds. And so right now, personally, I'm in a pickle. And I'm kind of looking at this, and I can see, well, maybe do you have to divide it between the short end of the curve and the long end of the curve as far as where you're kind of positioned bullish or bearish here? Because obviously you mentioned the 10-year. So the later you go out, you're starting to see things break out, but that
Yeah.
shorter end is starting to be flat, if not get a little bit bullish. How are you
Yeah.
kind of approaching this right now?
Well, it's so funny to me. You're absolutely right. You have to talk about which end of the yield curve are you specifically talking
Right.
about, because it was like mind-boggling to me that, Bloomberg put out a piece recently in the wake of the Fitch downgrade of,
Right.
US's credit rating, that they said there's this big argument, like Warren Buffett is bullish on treasuries and Bill Ackman is bearish, and they're taking opposite sides of the market. Well, Bill Ackman was talking about the long end of the bond market, he's bearish on, and Warren Buffett was saying, I keep buying 3 and 6 month treasury bills hand over fist, right?
Mhm.
Those positions are not inconsistent, right? You can be long the short end and short the long end, and be not expressing an opinion on the it, it seems to me that they were expressing the same trade, right? By
Right.
Buffett saying, I'm not buying long-term treasuries, that's a vote of no confidence in basically backing up what Fitch said. Now he said, you don't need to worry about the US's credit rating. They're going to, right? There's no risk of default. That's all true. But that's not what Fitch is saying, and that's not what I think Bill Ackman is saying, which is that, yes, the U.S. government's going to pay you back, right? But
Mhm.
they're going to pay you back. There's a good chance they're going to pay you back in dollars that have lost a lot of purchasing power over time. And so it doesn't really matter if you're buying 3 and 6 month treasury bills and they pay you back 3 months later, 6 months later, purchasing power has declined, a small amount, like whatever CPI numbers have told us by how much. But if you're buying 10-year and 30-year treasuries, it matters a huge deal how much that purchasing power has declined over that time period. And so you see things like the 5-year forward spread and things that are suggesting that this confidence in the Fed's ability to bring inflation down such that the purchasing power of those dollars is preserved is waning, right? And
Hmm.
so I think, yes, to be bullish on the short end is basically saying the Fed has done enough. I don't think they're going to raise rates much more. But to be bullish on the long end of the Treasury curve, you have to believe that inflation is coming down in a systemic way. That they've broken the back of inflation, and that recession is coming. That's going to be strong enough to really pull inflation down even further. Uh, and I think you also have to be confident to buy the long end that the fiscal side of things is going to get its house in order, and that spending's not going to continue at the out of control rate that it is, where we have an 8.5% deficit to GDP. So all of those things have to go right for you to be bullish on the long end.
Right.
Not very much has to go right for you to be bullish on the short end. So it's a totally different, conversation.
I mean, when your debt to GDP is 120% and your interest payments are crawling up to $1 trillion, in your federal deficit. I mean, can you go out and say your fiscal house is in order here, Jesse? It doesn't seem like it.
No, absolutely not. I mean, I think I read, I don't quote me on these numbers, but I think the Wall Street Journal put out an editorial this week that showed, just the interest payments on the debt are running close to 4% of GDP today.
Wow.
And that's that the whole Treasury curve hasn't even begun to be repriced at higher rates. So you have countries around the world that have interest, to GDP, interest payments to GDP closer to 2 or less, that have lower ratings, lower Fitch ratings than the US. So the only reason Fitch hasn't lowered the rating even more, because the fiscal situation is worse than a lot of countries out there with lower ratings. The only reason they haven't lowered it more is that we are issuing debt in our own currency, which is the reserve currency, which we can print more of, and so the risk of default is just not there. But that doesn't mean that the fiscal situation is better than these other countries with lower credit ratings. It just means we can print money, which
Right.
which doesn't like I said, it ameliorates the risk of default, but it actually increases the risk of being paid back in dollars that have lost even more purchasing power.
So we talk about the bullish case on the short end of the curve, and really the return on those treasuries. And also, and I also mentioned previous this week, like I was in my bank and they had a 6-month CD that was yielding 5% with an investment over $100,000, which I thought was really good. And it made me think, like, how much of this of the yield in fixed markets is taking away from the value dividend paying equities? Is it worth the risk putting cash into dividend paying equities when you can pretty much take far less risk putting it into fixed income?
Well, yeah, I mean, there's lots of different ways to think about that. One is with, just buying short-term debt, it gives you the optionality. And I think this is why Buffett is so bullish on 3 and 6 month treasuries, CDs, these types of things, is because you're earning, the best yield you on cash, essentially, that you've gotten in years and years and years, right? In over a decade. That's a good thing, but it also gives you the optionality to take advantage of opportunities in the markets when they arise. And so when you look at what are the valuations on those dividend paying equities, that matters as much as anything else. The price you pay determines your rate of return. That's kind of basically the fundamental thing that's driven, that's been underpinned Buffett's success for so long. And if I'm going to pay a high valuation for those dividend paying stocks, then, they're not going to help me out too much. I mean, my returns are going to be relatively poor. Now, but if you get a situation where you get a continuation of the bear market, a renewed downtrend in equities related to recession or whatever, you're going to get an opportunity to buy those dividend paying stocks at better valuations. And then over time, right, the benefit of dividend-paying equities versus short-term treasuries over the long run is that corporate earnings typically grow in line with inflation or a little bit better, and so the dividends will grow over time, and that's not the case with fixed income payments. So, but I do think it comes back to the valuation, and if you're paying extreme, like as my friend John Hussman has pointed out many, many times, even the cheapest decile of the stock market today, the cheapest 10% of stocks in the market are still closest to their highest valuations in history. So they're really, even if you're a value investor today, like Warren Buffett, it's difficult to make the case that you should be overweight equities relative to risk-free short-term debt, which is paying, like you said, 5% plus.
Yeah. A few minutes ago, you mentioned the dollar briefly, and this was another topic I wanted to hit on because the dollar's basically in a downtrend. It's making lower highs and lower lows on the chart here. A lot of dollar bulls out there. I mean, paying attention to this, how is this having an effect with markets, and I mean, we could even talk about precious metals because it doesn't seem like it's having much of an effect on precious metals lately.
Yeah.
Yeah, but watching this dollar, I mean, what is the ramifications here?
The dollar is in a downtrend. If you look at the dollar, I mean, for me, the main, pretty much the only fundamental you need to pay attention with the dollar is the direction of the federal deficit, the fiscal deficit. You look at how these dollar trends play out over longer periods of time, and they track the deficit, right? Deficit is narrowing, dollar rallies, deficit widens, dollar rolls over. So we saw the deficit blow out through COVID, right? I mean, we printed $5 trillion in new money, and the fiscal, paid out $5 trillion. As Stan Druckenmiller pointed out, $10 trillion of fiscal and monetary just blowout. So what happened? The dollar, initially spiked as part of that risk on move, but then tanked from like 102 down to about 89. And that was, reflecting the blowout in the deficit. Deficit started to improve from that point, right? After the fiscal stuff was over, and we said, okay, we've done enough. Dollar, went on to rally dramatically, but it peaked, it kind of last fall, and started to roll over. And that was around the time when the narrowing of the deficit ended and started to show signs of rolling over again. And so dollar has been weak because the deficit's widening again. And so I think to be a dollar bull, you have to think the deficit's going to narrow. And there's no sign of that, right? There's literally no imperative in Washington to rein in spending or raise taxes. And so the fiscal trend is not good. That's dollar bearish. And I think that's probably the main thing you need to pay attention to. Which way's the wind blowing? It's blowing in a fiscal winds are blowing in a bearish direction for the dollar. Now that should be very bullish for precious metals prices going forward. And they have, rallied over the last, since that peak in the dollar back in September, October, it's been a good rally for gold and silver prices. What I think they're wrestling with today, and specifically you look at today, is dollar yen is one to pay close attention to, because dollar is kind of weak today on the CPI number, but dollar yen is potentially breaking out of a pennant pattern. So dollar relative to yen is actually rising, and I think that's what has the precious metals perturbed over the last couple of weeks is dollar yen. Is I think you look at what the Bank of Japan is trying to do and get out of their yield curve control, but they're doing it in a way that's probably not as quick as markets would like.
Mm-hmm.
And so I think that's dollar yen has been rallying as a result. And I think you probably need dollar yen to roll over to really get a good move in gold and silver prices going forward. Now, the dollar yen specifically, you look at that level, that 145 level was kind of where it peaked and rolled over back in June, and it's rising back up to kind of test that level again. If we hit that 145 level and roll over again, that could be where gold prices and silver prices really find a floor and start to take off. I think that's probably the case. That's pretty key resistance right there, 145 in dollar yen. That's what I'm paying close attention to. And for signs of, it's time for precious metals to start to really run again.
Very well. It could be interesting timing because precious metals are really hanging on by a cliff right now. It almost we talked about the volatility in the bond market, a bullish or bearish case. I mean, it's hard to, you could go either way in precious metals. One of the things I wanted to ask you, and this is more of a big picture type of item here, Jesse. You made me think of it about dealing with fiscal deficit, and we know that there's two ways to do it. You can increase your GDP, increase your productivity, or you can add a couple zeros. And we know which one's the better way, but also the harder way. Are we in our friends, Grant Williams and Bill Fleckenstein, they always produce a great podcast called The End Game. Listen to it. I listen to it like the minute it pops. It's published. I listen to it. Looks like I need to take the dog for a walk type of moment.
Yeah.
you know, but I've been asking the same question for the last 2 years. How much closer are we to an end game here with the current fiscal and monetary policies in place?
Well, I'm a big fan of their what they put together over the last couple of years too. But they've been asking this question. It's interesting. Everybody they ask, seems to answer with kind of the same response. Well, there ultimately is no end game, right? There is no kind
Right.
of end point where all of this is going to kind of unwind. But I do think the point of using the term endgame is a valid one because we are seeing, in Japan, probably more specifically, uh, the end point. How do these policies resolve? And
Mm-hmm.
Bill specifically has said for years that he thinks at some point the Treasury market's going to take the printing press away from the Fed. And to me, I'm watching the Treasury, longer term Treasury yields, and I think we're at that point, right? Because uh, it's the fiscal policy that, right, with massive, we see this massive issuance of Treasuries. This is part of the reason
Right.
why rates at the long end are going up. A big part of the reason is Treasury said we need to issue massive more debt than markets were expecting, and that increase in supply is could potentially overwhelm demand. People, this isn't a crazy idea either. Ray Dalio's warned about this. Bill Dudley, former head of the New York Fed, has warned about this, that this year we're going to see probably turbulence in the Treasury market just relation to this supply demand mismatches. So, uh, we could be heading to a time here in the US where the Fed needs to maintain, a hawkish stance. They might not need to hike more, but they need to maintain a hawkish stance just to maintain credibility in the inflation fight. At the same time, we could see rates at the long end really start to take off, which could be problematic for a number of reasons, right? If you get 5% on the 10-year yield, you start talking about 8% mortgage rates, and right around the time when corporates are going to start having to refinance, hitting this maturity wall and refinance at double-digit interest rates, it could cause real problems for the
Mm-hmm.
economy, not to mention what it means for interest on the debt, for the federal government and things. So the Fed might be boxed into a situation where they're going to be forced to pursue some type of yield curve control. uh, that's going to be a really interesting time because if the Fed is forced to kind of go back into the Treasury market at a time when inflation is still, elevated, it could cause real problems for inflation psychology, a de-anchoring of inflation expectations, all these types of things. It's the last thing the Fed wants to do. Um, but so we're headed for a really interesting time, and I think that in terms of when I think of what does the end game look like, well, I think we're approaching that time that Bill specifically has been warning about for years, which is the bond market right now is sending a pretty clear message to the Fed. You haven't done enough yet.
Yeah.
5-year forward inflation forwards and stuff are suggesting that longer term inflation expectations are rising, right? There hasn't been enough done yet.
Would this be a
That
return of the
market,
bond? Like, would you say like a return of the bond vigilantes if this were
oh,
to happen?
absolutely,
Yeah,
absolutely,
full
yeah, and
force.
that's what's going on. That's what's going on, and so this should, what the Fed should do in reaction to this is say we're going to hike again in next month, and we're going to keep hiking until we really break the back of inflation, until the long end, it starts to come in, and those long-term inflation expectations really start to come down. That's what the Fed should do. Can they afford to do that? I don't think so. And so we're really, heading towards a very interesting time with inflation expectations, and the Fed's ability to counteract this fiscal largesse. That's doesn't seem like it's, going to do anything but grow worse.
And I'm curious what this does for inflation. I'm also curious. We're talking about precious metals and gold as a safe haven. The last run up of this inflation. We went to 9%. There's supposed to be this understanding that gold's this inflationary hedge, but it didn't really come into fruition here. I mean, is this is the second time the charm here? If we do get an uptick in yields, an uptick in inflation, and all this this kind of push and pull between markets and fiscal policy, is this fuel for fire for precious metals here, Jesse?
Well, to say that gold hasn't been successful as a safe haven, I hear what you're saying. That's
Yeah.
the bear case. But when you look at, where the gold price is relative to pre-pandemic, right? Let's look back to late 2019, early 2020, right? Gold price is still up, $400, right, over the last several years. Markets are forward looking. So what did the gold price do when all that money was printed? The gold price screamed higher from about
Right.
$1,500 to over 2,000, right? That was pricing in the inflation that was gonna come over the next couple of years. So if you believe that mission accomplished, inflation's gone away, then you should be bearish on gold, because as a forward-looking market, gold prices should start to probably head back down to that 1700 an ounce if inflation is totally under control. Fed's going to be able to reverse its the Fed's done enough. Now, if you think the Fed hasn't done enough and inflation's going to start to heat back up again, inflation will be one of the first markets to start, or I'm sorry, gold will be one of the first markets to start reflecting that. I think the oil price is already starting to reflect that.
Yeah.
Gasoline prices, these types of things, they have their own supply demand dynamics going on in each of these markets that are just as important, but they're forward-looking markets. And I think, oil price is starting to suggest that. Gold price, to me specifically, and silver have formed this, 2-year long bullish flag pattern. They broke out, earlier this year, back in the spring, they broke out to the upside from that flag pattern, are now testing the breakout level. So to me, it's about as bullish as a technical setup as I'd ever want to see for gold and silver right now. So it's amazing to me that, I mean, it's actually very, very good from a contrarian standpoint that nobody is bullish on gold and silver right now. To me, the technicals are extraordinarily bullish, that we're coiling right above at this breakout. It's a test of the breakout. It's literally like textbook bullish behavior in these things on the weekly charts. And I think, the breakout higher that we're going to see in gold and silver, in the coming months is going to coincide with a reappraisal of the inflation situation. People realizing, wait, inflation hasn't been beaten, and I need to own some gold and silver to protect myself from maybe with a situation that is outside of the Fed's control.
Well, if the typical investor isn't paying attention to gold, central banks, specifically central banks in the East, are paying a lot of attention. China's been a big buyer of gold. A lot of other, banks in the central banks in Asia have been buyers of gold. And there's a lot of talk about a BRICS gold monetary system here, and I wasn't necessarily buying it. I thought it was more of a headline and not necessarily a scare tactic, but a reason for gold bugs to have once again a news item that would support the bullish case for gold, Jesse. So I'm wondering, and since then, a couple of those BRICS countries have come out and said not necessarily interested in this. And then this same case, I understand the argument like, well, if Russia and China want to create a gold-backed monetary system for trading, like, are you really going to be buying a currency or using a currency that's put together by China and Russia? Watching this news headlines, is this something that is it worth paying attention to and keeping tabs on developments, or do you feel like it's a little bit kind of hyperbole and dead in the water?
I guess, it gets to my philosophy regarding a lot of this stuff. I mean, it doesn't matter what it is you want to look at, whether it's, political, market related, or anything. I like to stick to what we know. I mean, we can
Sure.
speculate about why things are happening, or and that sort of thing. But what we do know is that overseas central banks have less desire to own treasuries, more desire to own gold. That's probably all you need to know. I mean, whether they're
Mhm.
going to create some, you know, gold-backed currency, whatever, trading in their own currencies. I mean, it could be heading that direction. I don't know. What we do know is they want to own less treasuries. They want to own more gold. And it's probably due to all of these things we've just been talking about, which is, the drivers of the dollar and things is the fiscal situation. And if I'm an owner of long-term treasuries, that's the main thing I care about is the purchasing power of the dollars I'm going to be paid back in. And if it's evident that the country that's in charge of those decisions literally has zero interest in preserving the purchasing power of those dollars, then I'm going to be really wary of owning too many of those dollars, and especially in assets that are, in lending money to that country that, is going to, has no interest in preserving the purchasing power. So I think that's where I come down on it. I don't
Mhm.
know. We can speculate about what's going to happen and who's going to do what in terms of, trade and all these things. Well, I think what we do know is they want to own less treasuries, they want to own more gold, and that's for very good reason. And that should be all we really need to know.
Yeah. We're coming up on an election year, which is frightening. How's this all playing in? We were talking the political case of markets and the U.S. economy. I know historically, election years, the politicians like to do anything to support their cause here, but it almost seems like that's a heavy load to carry in this coming into the fourth quarter. Finishing up third quarter, going in the fourth quarter, and then hitting campaign trails really hard in 2024. I mean, what in your experience in your career, what do you see in election years, and what will this coming year be any different than what we've seen other and at the end of 4-year presidential cycles?
I mean, it's a really good question. It's super interesting dynamics heading into this one because you have a situation. I've read some speculation about, Russia may want to, see that Biden doesn't get reelected. How do they do? How do they have any influence over that? Right there, there's election interference stuff that Russia and China have been involved in, but Russia specifically has the ability to really cut off production of energy, ramp up energy prices, which would make it really difficult for Joe Biden to be reelected. So it's interesting to kind of think about that from that standpoint, that that's a possibility. But then at the same time, Fed has traditionally, implemented policies to support an incumbent. Jay Powell supposedly a Republican, so who knows how that works out. What we do know is markets are pricing in cutting of interest rates next year. If the Fed really did want to kind of support the incumbent, they would probably go along with that and say, yes, it's okay to cut interest rates next year to kind of support, the economy and reelection efforts and those sort of things. Now, obviously, if the gas and oil prices starting to really take off again, at that point, the Fed's going to have a really difficult time being able to cut interest rates in that type of an environment. So I don't. I mean, the answer is that's the long-winded answer to say I don't know. But but I think it's really interesting to think about.
Well, we could probably agree that we're not looking forward to the political year. I mean, it's always a disaster, and
Right.
it's never fun. All right, Jesse. Before we let you go here, I mean, is there a couple things I didn't ask you about, or things that very pertinent that we didn't cover that you think is worthwhile? Things you're really paying attention to right now?
I've written for the past month or so that 10-year Treasury yield is the most important chart in the world.
Hmm.
I'm still paying more attention to that than anything else because very much like the gold and silver price, it looks like it's formed a bullish flag pattern. I see it in the oil price too. I mean, the bullish flag pattern in the oil price is like a more than a decade long thing that it's
Hmm.
broken out of. Oil price looks to me like it could really scream higher over the next several months, quarters. If that's the case, it probably takes interest rates with it, and sends a very clear message about, this idea of soft landing and mission accomplished with inflation. So But I do think, the 10-year Treasury yield, 30 years been kind of leading, but the 10-year, if we get above 4.2% here on the 10-year, we're probably headed to 5, and that's a big deal. So that's something I'm watching closely.
All right. Great, Jesse. Thanks so much for your time. What a week. And I think it's just going to keep on spilling over into August. I mean, we still have quarterly financials coming out here. Those aren't done. And actually, we mentioned a video a while back that I think they released their financials here in a couple weeks even. So there could be a lot more volatility in the weeks and months to come. We'll be sure to catch up with you. Anybody interested in Jesse's work, it is great. Please go to thefelderreport.com. Jesse, have a great weekend. Thanks so much for your time, and we'll chat again soon.
Thanks, Trevor. Always good to talk with you.